So let's talk about actually making an offer on a home. You find first is negotiating an offer and getting to the point where you have an accepted offer. At that point, you have basically a sales contract, or they call it going under contract. Once it's under contract, the offer for the home, then you have a number of contingencies such as getting your loan approved, an appraisal, you have an inspection and your due diligence period. And then you also have a title search. So there's all these little things that once you get through all those contingencies and a final walkthrough, you can get to the point of closing on the deal. And then at closing, you have closing costs, and that's the whole process. Can take about 30 to 45 days. And in the coming videos, we're going to go over each one of those steps. So that's a summary of the whole closing process. The first step in this whole closing process is making an offer. And the first thing you want to do before you make an offer is to determine what's the fair market value of the home that you're interested in. And that's where what they call comps, which really is a short form of saying comparable properties. That's where a realtor can really help you and find a model match for your home in the same neighborhood that's sold very recently. That's the golden comp right there, because then you can find out really if it is a fair market value. If that's available, great. If it's not available, then what you can do, your realtor can help you find comparable homes nearby that have sold recently with all the same features. It's going to determine whether you're going to go close above the fair market value. In a seller's market, you offer more. If it's a buyer's market, maybe you can offer a little bit less. And that's what you're going to base your offer upon. You've made an offer. There's basically three possibilities. One is you're going to get the offer accepted, which is great. It will be rejected, in which case, you can move on, or you might want to think about making another offer. Or another option is there'll be a counter offer made. So perhaps the seller, is interested in working with you, but there's something in your offer that they don't like. Maybe, for example, where they want to have a lease back agreement, where they want to accept your offer, but they want to stay in the home for, say, 30 days after the house is sold. There are many possibilities for what could be in a counter offer, but they're the basic next processes of getting to an accepted offer. Is you make the offer, it's either accepted, rejected, or a counter offer is made. You might go through a series of counter offers, and eventually, hopefully, at some point you're going to get to an accepted offer, and then we get into the next stage of the whole closing process. So let's talk about appraisals. Let's say you've made an offer on a home, it's been accepted, and you've got a lender that's going to approve a loan for that property. They're going to send an appraiser out to the property who's a professional, and they're going to use comps to come up with what they think the property is worth. They're going to go back to your lender and say, this property is worth $195,000, and let's say the seller was asking for $200,000. The appraiser says it's worth $195,000. In that particular instance, you might have to renegotiate the contract. So that's part of the process. Or, the seller may say, we still want 200. In that case, you're going to have to come up with an extra 5,000. Or maybe the seller will agree to drop their price. So that's an example of how an appraisal can affect you getting from making an offer to getting to closing. Let's talk about financial contingencies. You've got your offer accepted. Well, two things. One is you have to actually come up with an earnest money deposit. That's usually going to be often they're around $3,000 to $5,000. Depends on the price of the property. The more the price of the property, the more the earnest money deposit will be. So you have to make sure that's deposited. And then secondly, in addition to that, you have to get your loan, approved by your lender. And usually have like 30 days. You're also going to have amount of money at closing costs. Closing costs will be the full amount of the down payment you're going to be making, which is either 10%, 5%, 3%, whatever it is you've agreed to. And secondly, there's an additional closing costs, which usually run about 2 to 3% of the overall price. So you just have to come up with all that money at closing. They're your financial considerations in getting a deal closed. About home inspections as part of the buying process. you've got your accepted offer, you have so much time, it's called a due diligence period. It's often 10 days to inspect the property, and really what everyone recommends you do is you get a professional home inspection done. What that's going to do for you, they're going to go in, they're going to look at the major structural components, they're going to look at the electrical, the plumbing system. They're going to tell you, you're going to be able to tell you if there's problems, potential problems, in the foundation. They're going to look at the roof, they're going to look at all the major components of a home. They're professional, they know what they're doing, they have highly sophisticated equipment, and they're going to be able to tell you in their report of what potential issues you might have in major systems of the home. So this is really, really important, and any realtor worth their salt is going to tell you you should absolutely get a home inspection. Let's talk a little more about inspections. Let's say you've got an inspection done. The first time you look at a home and you get a home inspection, it might be a little scary because you might get like a 30-page report. Inspection reports are lengthy, with a lot of detail about every system. They're going to give you guidelines of what you can expect. So you don't be scared by a long home inspection report. That's pretty standard. And the main thing you want to be looking out for, just like buying a used car, you don't expect a used car to be in perfect condition as if there's never going to be any kind of problem or issues down the road. Same as with a house, it's been lived in. So, that's part and parcel of buying a home. What you really want to look out for is there are no major issues, like say with the roof, or with the foundation, or there's no major problems with the plumbing or electrical system. Talk about what's called CIC disclosure. So if you're buying a home that's in a homeowners association, which many properties are, the seller is required to give you a copy of a homeowners association or an HOA, and that's going to have a whole bunch of rules and regulations in it telling you what you can and you can't do. For example, in a condo or townhomes, you may or may not be able to have pets, for example. So there's all kind of things that are involved in that, and the seller is obligated to give you a copy of those before you close the deal. So, and then you have time to review, those documents, the homeowners association documents, and you may decide after viewing those that you actually don't want to go ahead with the purchase. So you have that option as well. So that's all part of getting to closing. So let's say you had a home inspection and you found something that was unexpected. Maybe there's an issue with the plumbing or the drainage or electrical or something else. And this can be a part of the process where there's a contingency here. You have an option to back out of your contract if you don't like what's in the home inspection report, but the other option is just to renegotiate. Now, some sellers will say you have to buy the home as is, and some will be open to negotiation, but that's all part of the process. If you have a good realtor, they're going to help you through that process. And so there can be a lot of back and forth discussion at this point in the home buying process. After you have the home inspection, what you see in it, if you don't like something, there can be some renegotiation. That's all part of the process of getting to closing. Part of the whole process in closing from getting an offer is a final walkthrough. It's usually say 3 days before the end of the period to close the deal. So let's say at this point you've had your inspection, maybe there were some issues that needed to be ironed out, some issues were fixed, and then you can do a final walkthrough to see maybe it was an electrical issue that was fixed by the seller, and then you get a chance to walk through and see that in fact it was fixed, for example. That's your final chance. The final walkthrough is really your final option to do any negotiation. Once you pass that point in the whole process, you kind of really don't have any leverage to do any more negotiation. So that's another key component. A contingency is a final walkthrough. Make sure you do that. Make sure you complete that as part of the process of getting to closing on the deal. Say you're finally getting to the point of closing on the deal. You've been through all the contingencies. And closing is where you actually meet and you sign the documents. And the closing costs are usually around 2 to 3%. Maybe even higher of the overall price. So if the home was $100,000, it's going to be about $3,000, and that covers things like title insurance. There's inspection fees, appraisal fees, There's fees for the lender, there's lending fees, there's just a whole bunch of fees. In other words, all the people that have been involved in the transaction, that includes escrow. So there's a lot of people involved in making a transaction happen legally, and obviously they're all going to need to get paid for their services. So that's what closing costs are all about, and you're going to have to come up with, you can figure about 3% of the price of the home when you close. Get your offer accepted, the next step for you is you have to provide a certain amount of money. It's called an earnest money deposit to the seller, but you don't give it directly to the seller, you give it to the escrow company. They're like a third party, a neutral party that's going to hold that money on behalf of you, and then they're going to give it to the seller, you know, when the deal closes. For some reason the deal doesn't go through. For example, sometimes after a home inspection the buyer may decide they don't want to buy the home. They have a right to get that earnest money deposit back. So rather than trying to get that back from the seller, the escrow company holds the money for you. If you pull out, they're going to give you your money back. So it's just the way to make everything easier for everyone is by having a third party. And that's the beginning of escrow, when you give them the money. All the requirements for getting your loan approved. What are those? Well, first is you've got a preliminary title report. That's part of the closing process. And so hopefully the title report is going to show what they say you have clear title. Most times that's the case. Secondly, the house has been appraised by an appraiser, and the value that the appraiser put for the home is at least the amount that you're asking for a loan. That's a second condition. A third condition is you need to have documentation of your proof of income. And then lastly, you need to have proof that you've actually obtained home insurance for the property. So those are the things you need to do to get your loan approved. And until you get your loan approved, you know, obviously that's an essential part of getting to closing. Let's talk about the title of the property. Now, the title is actually what you're purchasing. When you buy a home, the title, which indicates who actually owns the property, is going to be transferred from the seller to you as the buyer. The main thing you need to know is part of closing costs is title insurance. Title insurance basically means that it's a policy that ensures you that you're the rightful owner. So let's say down the road someone makes a challenge to the title and say, hey, actually I own this property, not you. Your title insurance protects you against such a claim. So the lender will absolutely require you to buy title insurance. That's going to be about $1,000 in the policy. But what you need to know is that's just for the lender. You should get your own title insurance in addition to the title insurance you're required to get. Let's talk about homeowners insurance. As part of closing a deal on a real estate transaction, the lender is going to require you to purchase homeowners insurance in order for you to get the loan approved. What this does is a homeowner's insurance policy is going to protect the home in the case of a major wind, fire, rain, or vandalism, or some kind of, you know, event that destroys your home, and it's going to cover 100% of the replacement cost of your home. You're going to need to purchase that. The costs vary. It's going to be, we'll go over that more in another video, but just know you're going to be required to get homeowners insurance to get your loan finally approved and in order to purchase your home. That's what homeowners insurance is about. Talk about closing disclosures. What's that all about? That's a document that you're going to review, and it's going to go over all the critical terms of the loan, like the interest rate, your monthly payments, how much, you know, taxes and insurance you're going to be expected to be paying out of your monthly payments, whether there's any conditions in the loan, such as a penalty for paying the loan off early. You're going to have a few days to review that. You need to review that as soon as you get it, and you're going to have to give it back in order to proceed to closing. That's a very important document, and that's a sign that you're really right, literally on the doorstep of getting to closing and getting your new home. So get your closing disclosure, review it straight away. If you have any questions, of course, you're going to go talk go to your lender and discuss, any terms or conditions you're not sure about, and then you get it back, and then you can get to closing. Final meeting, the seller's going to be there, the real estate agents, the lenders are all going to be there. You're going to sign the documents, you're going to get the keys to the home. And what do you bring to that meeting? Well, you're going to bring your home insurance policy, you're going to bring your ID, you're going to bring a list of the places that you've lived in for the last 10 years usually, and then you're going to bring cash to close, a cashier's check. And what that will be the amount of your down payment that's left to pay. Let's say, whatever is it, 10% or 5% or 3% of the actual amount that you've agreed to pay. You're going to bring that. Plus, in addition to that, you're going to bring on that cash amount your closing costs, which we've said numerous times is around 3% of your actual purchase price. So you're going to bring all that money in a cashier's check. Then you're going to all meet, sign the documents, and congratulations, you got to closing, and now you have a new home. While you do have the title that the home is in your name, you do have what's called a lien, L-I-E-N, a lien on the property by the lender. What that means is that even though the home is technically yours, if you default on your mortgage, in other words, if you stop paying it, the lender has a right, that's what a lien means, is that they can now take that house and sell it in order to get their money back. And other people can also have a lien on your house. Let's say you have contractors that do work on it and you don't pay them. They can take a lien on your title. But that's just the next phase of after you close, then you get into, living the life of being a homeowner and having a mortgage. And it's good to know what that means. You've now got the title to the property in your name. Now the new phase begins where you begin your mortgage payments. We're just going to go over a couple of key concepts here. One is, firstly, escrow. Here's a different escrow account you're now going to open. You had an escrow account during the closing process to hold your earnest money deposit. Now you've closed. Now you have a different escrow account in which, part of your loan and your mortgage payments is going to be put into a separate account called an escrow account, and that money in that account is going to be used to pay two things: taxes that you owe on the house, which is, yearly you have so much taxes to pay, and also your insurance premium for your home insurance policy. But that's just the next phase of after you close, then you get into, living the life of being a homeowner and having a mortgage. And